Hello, everyone. This is Zak Gardezy. I'm the host of Money Minutes and the founder and managing partner of Wealthstone Private Wealth Management. Here on Money Minutes, I'd like to share with you some of the latest market headlines and my outlook for what's ahead. And so for this week's video, I'd like to do a follow-up on last week's topic of interest rates and inflation and really the Federal Reserve's decision. And then I'll also share an interesting topic, really a question that I get a lot these days, is around the presidential election and how does the market react based on, if we have one party over the other, if we have a mixed, legislative branch and executive branch. And so I'd like to share with you some interesting facts and really busting a myth that I hear a lot, whether it's on TV or if I'm reading a research piece. I've got some interesting data to share with you there. So let's get right into it. So on the topic of interest rate cuts and inflation, we've got some welcome news coming out of the Bureau of Labor Statistics when it comes to CPI. And remember, CPI is the Consumer Price Index. This index tracks the changes in prices for really consumer goods and services across the United States. It's a pretty all-encompassing report, and over time, especially this year, we've gotten some mixed results, and a lot of it has been fairly negative. But the May results that were just released at the same day where the Federal Reserve was concluding their FOMC meeting, we got some really positive news. And so the CPI report came in at 3.3% year-over-year increase in inflation, where the expectation was 3.4%. So really what that means, and it doesn't sound like a huge number, right? We were expecting 3.4%. But we got 3.3%, so that means slightly lower than expected inflation. But the key there is that it was lower, and we've gotten multiple reports this year where it was actually hotter than expected. And so finally, we're getting some positive inflation news and giving the Federal Reserve the confidence that they need to potentially cut interest rates. And so once the data came in, the markets reacted very positively to it. And then all eyes were on Federal Reserve Chairman Jerome Powell and what his commentary was going to be. And really, Chairman Powell came out and talked pretty positively about the data and said, look, if we continue to get reports like this, we're going to feel a lot more confident when it comes to cutting interest rates. And interestingly, really as expected, the CME Fed Watch tool, which I reference a lot, which kind of helps track investor sentiment and where investors think the interest rates are heading, the interesting report was that in September, which, there's already a lot of speculation around getting a cut in September, but over the last few months, the odds of that have been just dropping from a pretty high likelihood to, closer to more like a 50-50. Well, the September rate cut expectations went from 46.8% up to 62%. And so that's a major shift in investor sentiment. Basically saying, and this is what the Fed was saying too, that if we get more data like this, pretty much locked in for an interest rate cut, at least in September. Now remember, I'm not in that camp. I think that we'll get at least one cut this year, but it'll likely come in December, mainly because some of the major factors around inflation, I just don't see them reversing over the next month or two, which will provide a trend that the Fed is looking for and justification for a rate cut. Now, some areas of inflation that went down as of the last CPI report that was released, it was really around new auto sales. It was around auto insurance, transportation. And so in these areas, and energy was a big one. In these areas, CPI showed a decline in prices, which is great. But in an area where it's very important for CPI, which is in shelter increased, and so did medical care. And so when you look at this, you're seeing shelter, which is a major part of the CPI report, continuing to trend upwards. Now, that is a lagging indicator, which means that the shelter prices that we're getting today and what's reflecting in the latest CPI data is really older data, may not be reflecting what's happening on the ground today. But nonetheless, it's the latest data that we have, and it's not declining like some of the other areas. And so that's something to worry about. And again, it brings me back to my thought process of, do we see shelter just falling off a cliff over the next month or two where everything else continues to head downward and then we get justification for a cut? I don't think so, but we'll see. So we'll keep very close eyes on the latest inflation data. I'm sure we'll talk about it in future episodes. But the latest data has at least been positive and some good news and boosted the markets. And so, again, we'll pay attention to some of the new reports that come out, but just wanted to share that latest update with you all. So on June 27th, live on CNN, we're going to get the first presidential debate between President Trump and President Biden for the 2024 campaign cycle. And now it's very common for clients to ask, and I've been getting a lot of questions about this. We've had such a great year so far in the markets. What's going to happen with my portfolio depending on what happens in the election? And as you know, of course, the presidential election is the big topic everybody really focuses on. But Congress has a lot of seats up for grabs, both in the Senate and the House. And we could have a complete wave, one direction or the other, or we could have a divided government. And so I wanted to drill into a myth that I hear a lot of, which is that a divided government typically results in the best returns for the market. And I've heard that for a long time, and I believed it for many years until I drilled into the data. So the data shows us that a unified government actually typically provides the best returns. A unified government means you've got the same party as president and in control of Congress, whereas a divided government, of course, is the opposite, where you've got different parties in the executive and legislative branches. And so, the old theory or the myth really of a divided government typically provides the best returns, I think that comes from the notion that you have gridlock and stability, right? You can't make extreme changes in policies if, the president wants one thing and the Congress is a different party, so they're not going to oblige, and they're going to have a lot of negotiation and probably not get anything done, right? And so the markets love, this is what was said for many years, the markets love stability and when things don't change. Well, when you drill into the numbers, actually, a unified government, historically, on average, doesn't really matter which party, provides an average annualized return in the S&P 500 of just over 14%, whereas a divided government is just over 10% annualized. So neither one of those returns are terrible, but there's clearly a difference in favor of a unified government. And so now when you drill into the divided government, that's where things get a bit interesting. So a Republican president with a Democrat-controlled Congress typically provide the worst returns at just over 7% annualized, whereas a Democrat president with a Republican-controlled Congress provided some of the best returns at just over 16%. Now, I'll let you come to conclusions as to why that is, but I just thought that data was interesting. Now, this means, if we look at historical election cycles, a unified government is fairly rare. So we're likely, especially when you look at some of the latest polling data, to get a divided government. So does that mean bad news up ahead for the markets? I don't think so, because it's not just the presidential election that's driving the market. Or really, it's not really a major factor, I don't think right now. It's really the major factor is artificial intelligence and technology, which is driving most of the returns of the S&P 500. NVIDIA was just reported as providing over a third of the S&P 500 return by itself. And so it's very clear what's really driving the market. So I wanted to drill into how do either president, what are their opinions on artificial intelligence? President Trump recently on the Impulsive podcast with Logan Paul talked about, artificial intelligence being like a superpower. But he did talk a lot about the risks and how evil can be conducted using the technology. And so people should approach it, government should approach it cautiously. But he shared an interesting story about how one of his writers used artificial intelligence to create one of his speeches, which he then went on and actually used at an event. Now, he didn't talk about which event it was, but this shows that President Trump, at least, seems to be on board with artificial intelligence in a safe manner. President Biden, as well, at the G7 summit over the weekend, met with world leaders to talk about a host of issues. One of them was using artificial intelligence, putting some guardrails in place, and putting some agreements to use the technology ethically and really safely around the world. And so either administration seems to be on board with artificial intelligence and this technology that's accelerating rapidly and getting into all of our lives. And so I don't think that depending on the outcome of the election, either administration is going to come in and derail the momentum that we have going on right now. And so I'm not concerned about that. I'm just more interested to see how the outcome is. And there's a lot of other things that are up for grabs too. Like, for example, the current tax code, the 2017 Tax Cuts and Jobs Act, is expiring at the end of next year. And so whoever wins is going to have a heavy hand on the next tax code, which changes everything from capital gains, income tax rates, estate planning, you name it, business taxes, everything could potentially change depending on who wins when it comes to taxes. And that's just one of many important issues to focus on. And so I just wanted to share this interesting information with you. Busting a myth. I shared this article on my LinkedIn page as well as on our website, where I go into a lot more detail and you could see more specific numbers and my opinions. But this concludes this week's episode of Money Minutes. I hope you took away some valuable information, and I look forward to seeing you all again next week. Thank you very much.